Thank you for tuning in to watch our Invest Tampa Bay 5th Anniversary Launch Conference. You're about to watch panel number 2, Financially Sound, evaluating the actions over the past 5 years in the banking and financial sector and what that means for the future. Enjoy.
Well, good afternoon again. I am delighted to be leading this panel. I have big shoes to fill. Damon was moderating our panel last year, and if you think banking is boring, you would be absolutely false in thinking that. It was one of the most entertaining panels that we have led at Capital Analytics for some time, and I've gotten to know these bankers and experts on the stage with me, and surely they have some wonderful knowledge to share with us. And also, they're really wonderful people. So I'm delighted to get into this discussion today. And so we are talking about financially sound, evaluating how the last 5 years has shaped us today and what that looks like for the future. And, shameless plug, we are celebrating 5 years in Tampa, so that's why we chose the past 5 years. But I always think it's a nice time to look at because it's a medium term, right? And in this medium term, things have changed a lot over the past 5 years. So I think that gives us a lot of room for discussion today. So kind of to kick it off, I'd like to throw a question out to the entire group. And so in light of us celebrating those 5 years, reflecting on Tampa Bay's current financial landscape, how is the market today different from where it was 5 years ago? And where do you see the starkest differences? Maybe we'll start on the far end and move our way back here.
Really?
Yes, really.
You're supposed to start right there. So, I think the way that I like to describe this easiest is, let me ask right quick, did anybody buy a car over the last couple of years? Show of hands. See that? Okay. So let me give you my quick story on what I think describes the biggest change in the last 5 years. All right, so picture me 2018. I'm going to buy a new car. It's a black, Grand Cherokee with black rims. It was lit. It's fire. I'm excited about it, right? I go online and I see the inventory and I go to the dealership and I sit there and I buy the car. And guess what, y'all? It had a beautiful interest rate back in 2018, okay? Now, fast forward to 2022. Now, I decide that, and it was not a great decision, I was going to hand my beautiful 2018 black on black Jeep Grand Cherokee down to my son. Now, I didn't really like a lot of the vehicles that are out there, so I decided I was going to step up to a 2022 black on black Jeep Grand Cherokee, okay? So I go online, and lo and behold, even though we had supply chain issues, it's out there. I'm like, wow, there's like 3 in the area. So I go to the dealership. Nope, it wasn't really on the lot. Someone had ordered one and it was in their inventory, so they got me on the lot. Long story short, it took me 5 months to get my beautiful 2022, which wasn't a 2022, by the way. I ordered a 22, got a 23, and the interest rate, y'all, it wasn't as beautiful. And that ultimately, I think, describes a lot of the big changes that we have. We all know that when banking and finance is breaking news on the television, that's not good, y'all. And that has been inflation, price increases, and everything else we've had to deal with, but we've had a very resilient market.
Sean?
So this was kind of easy for me to reflect on because I came back to the region about 5 years ago with Synovus. And so I remember very well, and I'll actually kind of change the narrative a little bit in the similarities that exist. Back in 2018, we saw a roaring economy. I think GDP was the highest since 2005. The Fed started tightening, started increasing rates at that point in time. And by the end of the year, we started seeing, on a national standpoint, the economy slowing a bit. But in Tampa Bay, we didn't see that at all. I think unemployment was under 3%. Nationally, it's 3.7%. Wage growth was double the national level, and wage increases were 5 times the national average. So in a lot of ways, the core fundamentals in Tampa Bay were very, very strong going into the pandemic. Fast forward, we have the pandemic in 2020. We have a surge in liquidity pumped into the system. We had pent-up demand, so on, and so we had supply chain issues, so on and so forth. But on top of that, we had global inflation. And so now we see over the last 18 months, the Fed has been tightening. We've tightened at unprecedented levels of 11 increases. Thankfully, not today. We didn't get an increase, but 11 increases, over 5.25% to interest rates. Everything's become more expensive. But I go back to the underlying fundamentals in the Tampa Bay region are still very, very strong. I'm very optimistic. We're in banking, and you say, how are you optimistic? Well, I find that tough times like this are times that as an organization we grow, we thrive on, because a lot of folks, aren't optimistic. They tend to take those administrative burdens and operational issues that are in front of them and kind of hide under the desk, where I think it's a time to get out there and continue to help things like the previous panel grow and be prosperous. And so I'm optimistic about it. So the biggest change is costs. The house I bought, I probably couldn't buy today. But there is an awful lot to be excited about in the region right now.
For sure. Paul?
Well, in my neck of the world, I own a financial planning firm. And what I think the biggest difference for me, and how many financial advisors are out there? Raise your hand. There's
3.
Yeah, 3 of us. Okay. All right. Figure there'd be more than that. But I'd be interested in what your thoughts are on this. But over the last 5 years, I guess the biggest change in my world is what families and clients demand out of us. I think from a financial planning standpoint, that's what clients are demanding. I think the days of saying, hey, I'm great at picking mutual funds or I'm great at buying stocks, I think those days are over with. The branding at our firm is we keep your financial house in order. And I believe that financial planning, just like a house has a bunch of different rooms in it. They need to be kept, they need to be cleaned, they need to be sometimes completely refurbished. It's the same thing with financial planning, and investment planning is just one of the rooms. So families, they need help with not just their investment planning, but they demand that we help them with their healthcare directives, their trusts, their wills, and the way that they title their assets. So that's the biggest change in my world is the demand for services that families have now.
And I think that, we were touching upon it a little bit, Sean and Paul just now, I think that we all agree that we're seeing an emergence of a new financial paradigm and how that is shifting how you're tackling business. But what does that mean? What is the most immediate near-term impact for your individual businesses given this shift? Maybe we'll start this way and go back down that way.
Yeah, well, in the investment world, we're experiencing the biggest shift that we've ever experienced in the history of it, and that's the great wealth transfer. And so as the baby boomers pass away, we're having this massive shift of wealth, and over the next 2 years, there's going to be more money controlled by women than men. There's going to be, and then by the year 2028, there's going to be more female.
Yeah, that's worth an applause, man.
Yeah, there's going to be more female millionaires than men, and so I think what we're doing at our firm in order to be prepared for that is 75% of our firm are females, yep. And because when women, for the most part, they're going to be inheriting that money when their husbands pass away, and that's how that transfer is happening. 80% of females, once their husbands pass away, they fire their financial advisor within the first 12 months. And so we
doesn't bode well for you, but
that's why I'm hiring a bunch of females. But so that's a big change coming.
What do you attribute to them letting their financial advisor go?
Oh man, I give a whole seminar on this.
In a nutshell?
Because there's really 3 reasons. Men and female have a tendency to not communicate very well.
Sure.
And the other thing is. People in my business, when a husband and wife come into the office, we've developed really bad habits of just focusing on the male. Yep. And women tend to hold that as a grudge. And when they get control of the money, guess what they're doing with it? They're moving it. Yeah. And then the other thing, men, we're all guilty of speaking in sports analogies.
Sure.
So, and women hate that. So That's one of the, during surveys, when they're surveyed, that women talk about how much they hate sports analogies.
Sure.
So those are three of the big reasons.
Well, I love how 75% of your employees are women. Hopefully you can retain all of your clients.
That's the game plan. I always get outvoted at the office, by the way.
There you go. Sean?
So I absolutely think, from a banking perspective, there's been a paradigm shift, and it might be near term in nature. But when you think about the pandemic and what really occurred during that period of time, there was $7 trillion in liquidity pumped into the banking system, just an immense amount in a very short period of time. Meanwhile, banks had to deploy that capital, and they did. And many of you probably got a loan during that period of time, and lending was very strong. Then what came about is, obviously the battle of inflation and increased interest rates started, as I mentioned, about 18 months ago. And they went up in such a rapid fashion that there was this intent on banks to have to keep those deposits to some degree, because we've lent a lot of money out. So what we've seen over that period of time, it's $5 trillion of that $7 trillion has been deployed. It's not on balance sheets anymore. Whether it's been deployed to pay down debt, whether it's been deployed to use that instead of lend money at a higher cost to lend money these days, or whether it was deployed to go into higher investment vehicles, it was deployed. So there's a battle right now for deposits, and we're seeing things like historically high betas, and what I mean by that is the amount we pay in interest as a percentage to the amount that interest rates has increased is a record amount. You would have never ever seen interest rates being paid on savings vehicles higher than the Fed interest rates are, and today you are. You just drive down the street and you'll see 5.6% for a CD. That's unheard of. And so we're being squeezed from both sides, both from a balance sheet perspective as well as from on an earnings standpoint. Now that being said, the regional banks have probably gotten beaten up a little bit. There were some bank failures. I do believe those were idiosyncratic in a way. Those were very unique situations. The banking system is very, very strong right now, and there's, even though we have that headwind, we do have tailwinds behind us. Of course, most of the regional banks, we have fixed rate loans. Well, those will start to be repriced at those higher rates. So the other piece I would say is this level of scrutiny and regulatory pressure will be on higher levels of liquidity and capital. So it's going to require banks to grow at a more measured, balance sheet measured way. So the old days of a bank growing 15% in loans and 3% in deposits won't happen. So sectors that are perhaps more capital intensive and less balanced in terms of deposits, it's going to be harder probably for in the near term anyway, from a lending perspective. So I do think there's a near term paradigm shift, and that's what's really been the cause of that.
And Damon?
Well, Sean, you just broke down all of the banking elements, and I have to say I completely agree, but I'm going to take this question a little differently.
Sure.
So the question was, is there a new paradigm? So the answer is the current paradigm is different, high interest rates and inflation, right? But when I think about banking from a community bank standpoint, it's a small business, and we all have to deal with what's happening in the economic environment from all the different headwinds, tailwinds, and all these different changes. So for me, what's changed right now is altering the risk-reward factor. And I think, Sean, you kind of spoke to that. Altering the risk-reward factor, but looking at this as an opportunity to figure out what the new needs are for clients and customers, what the unmet needs are for clients and customers, as well as recognizing that there's areas of our communities that are underserved, and how can we take an opportunity to serve them better. So from my standpoint, I look at it this way. We all, in all of our businesses, have to be cognizant of being resilient. We all have to be aware of change agility, because the world changes so much. So how do we change that into a competency? While at the same time saying, if there has been a paradigm shift, then where are the opportunities? And I'm not going to use a sport analogy, but I am going to say that we can play offense as well as play defense. And you can do that even in Uno. So that's not, Monopoly, Uno, not necessarily a sport analogy. However, there is a great opportunity in that regard. So to me, we all know that, guess what? 5 years ago, we were in a low rate environment. Today, we're in a high rate environment. Guess what's going to happen down the road? It will change again, and that's what we need to be prepared for.
Well, you were going into how community banks are specifically kind of pivoting at this moment in time. So, Damien, I'd like to throw a question your way. In a financial landscape marked by consolidation and acquisitions by larger institutions, the concept of community banking has continued to change. What does it mean to be truly a community bank in 2023, and how are institutions like TCM helping to shape what the future of community banking looks like?
So let me start by saying that I don't believe that community banking in 2023 is fundamentally different than community banking in 1965, 1970, 80s, and 90s. I know there's a lot of pundits that try to classify a community bank by virtue of asset size, large bank, small bank. I look at it this way. A community bank takes local deposits and then turns those local deposits into local loans. That's it. And it's dedicated. So larger banks will operate in, say, multi-state or national. They're going to be taking deposits from one state and deploying them in another. That fundamentally is the difference between community banking and, we'll just say, big banking, right? The second piece is relationships. So if you are taking deposits from your local community and investing in your local community, chances are you know who you are dealing with. You're not a 16-digit number. You're not a routing number. You're not a number, you are an individual. And so that allows for lending decisions to take into account some of those extra things, if you will, that you might not know if it was purely some type of AI, lending mechanism online, right? So, and then the third thing is community engagement. We all are probably familiar with CRA. I'll be honest with you, I hate the fact that CRA has to exist because I believe that community banks are already going to invest in their local communities because a community bank cannot thrive unless the communities they serve thrive. So I do believe that that is going to remain the same. I take a lot of pride in what happened with PPP. We talked about pushing liquidity into the system. It was the community banking space that understood small businesses that made that happen. Community banks do today about 60% of all small business lending. We talk about local community. That is significant. Community banks also employ about 700,000 folks across the country. So you can tell I'm a community banker and I love what we do because we're community first, service first, profitability second. The last thing I'll throw out there is that there are so many we'll just say underserved communities. And we talked a little bit in the last panel here about cultural diversity. Well, there's also something called financial inclusion,
Sure.
and there's also something called bridging the wealth gap. Yep. And I think on the public and private sectors, we have the ability to do more in that arena. Affordable housing is a challenge. I know transportation is a big deal, but I'm an affordable housing guy because I think the house is foundation to the family is foundation to the community, and of course, I'm a community banker. Sure. Now, as far as TCM, we are a community bank, but we're also part financial technology provider. So we partner with 750 community banks across the country, providing them the grown and sexy credit card services. You never heard that before. I'm telling you, you might as well just write it down. Grown and sexy credit card services, right, to allow for them to compete against the Capital Ones and the American Expresses of the world so they can support their communities in deeper and more meaningful ways. And that's what ultimately drives our business model.
And banking is not boring.
Banking is not boring.
Paul, I'd like to toss you a question. While technology like AI is a popular subject in financial circles today, how important is it that financial institutions do not overlook the value of maintaining human capital on staff? And second to that, what overall investments in AI and other technologies are being made today that will change the wealth management landscape for the next 5 years to come?
Yeah, that's a really good question. And the way I look at AI is really from three different levels. The first is, as we talk about investment planning, how does AI, how can people profit from it, from their investments? And obviously, when you buy a stock, stock prices go up when earnings go up, and stock prices go down when when there's an anticipation that earnings are going to go down. So any company that's involved with AI and it can make their earnings grow or their expenses drop, that's going to affect their earnings. So I think that's a major thing over the next 5 years as far as just investments. As far as the firms that the financial planners work for, my company, Raymond James in St. Pete is my custodian. And there's a big move towards AI as far as helping us with compliance, helping Raymond James service advisors like me, and then anti-money laundering things. So there's a big pro there. And then finally, the third that I look at as far as AI is how is that going to affect the firm itself and the way that we work with clients. And I feel like that 90% of our jobs is working, as a psychiatrist, and then 10% is math. I mean, the most important part of our job is to make sure that clients don't make knee-jerk, reactional, emotional decisions. That's the best way to not accomplish your financial long-term goals. There's an argument that AI may put people like me out of business, but I don't see it that way. I think that AI can help us become more effective, but also I think human beings want to work with human beings. And I'm not quite sure how AI at this point is going to help human beings from not making bad emotional decisions. And I think that's the biggest part of what we're here to do.
And Sean, I'd like to also toss you an individual question. In your interview with Invest Tampa Bay, you mentioned how philanthropic and community giveback has been part of Synovus's culture for a better part of 20 years. How do these efforts demonstrate the change in how financial institutions support business and community growth beyond loans and credit lines? And why will efforts like this be vital in guiding the region as we move forward?
It's a great question. I think the 20 years was I was speaking about Synovus in this region. Giving back to the community has been part of Synovus for 135 years. It's deep in the soul of the organization. As a matter of fact, when I joined the company 20 years ago, I had worked at a previous bank and it was never even talked about. And here it's a way of life. Our team members are almost expected to get involved with something they're passionate about, but get involved. We certainly put our dollars back towards into the community as well. We have two key initiatives that we do. One's called Here Matters. That's really where we put our talent and resources back in the community. It's meaningful to us. We tend to invest in things like education, children, economic activities, things that make a difference and a betterment to the community. Secondarily to that, our other passion is around financial literacy. We call that Raise the Banner initiative. We tend to partner with schools, universities, nonprofits, and we have hundreds of volunteers that go out every week and teach financial literacy classes to kids and adults alike to hopefully make their lives a little bit better, help them make better decisions, and help them have a more prosperous future. So thank you for the question.
Excellent. And all good things must come to an end. So I want to throw one more question to the group before we move on to panel number 3, and then after that, our celebratory cocktail hour. But given the last 5 years of significant economic development and change in the industry, what do you see as the future of the financial industry over the last 5 years? Who would like to start?
Yeah, I'll go first.
Sean.
I think it's like any industry. When you have a kind of shock to the system, what do you tend to go back and do? What you're good at, the core fundamental part of the business. I think over the next 5 years, we'll see a lot of investment in core consumer and commercial banking and traditional banks, and probably less in non-core businesses, ones that don't provide a strong funding source, for instance. I think there's going to be lots of consolidation in the market. I think if you look out 18 to 24 months from now, when things hopefully are more normalized from a sector perspective and banks stock gets to be what they use for acquisition tools, gets back to a more normalized level, I think you're going to see, don't go buy bank stock, by the way, on me saying this, but I think you'll start to see a lot of activity. And the reason I say that is there's certainly increased costs and regulatory requirements around liquidity and capital, and banks need to get scale to basically take that on. And there's also continued advancements in the digital and technology space, and scale helps develop that and helps us compete with one another. So I do think you'll see consolidation in the market. I think you'll see a higher, this one probably will surprise people a little bit, I think you'll see a higher focus in retail and consumer banking and less branch consolidation than maybe you've seen in the last 15 years. There's been a big trend, as you all know, with the onset of things like mobile banking, things of that nature, people don't go to the branch as much. However, we do know that people want to bank somewhere, typically, that a branch exists. If they need to go talk to someone, they want to know that that's available to do so. And so you have to, although you have to be in the market, you don't have to be everywhere. That being said, with the importance on deposits and core relationships going forward, we're going to have to be awfully careful when you're managing your distribution system. And I see a less consolidation in branches. And then obviously, as I mentioned, continued expansion and investment in digital tools and resources. The world wants Amazon in everything they do, and it's no different in banking, and that will be a continued trend as well. Thanks.
Fabulous.
Well, he just segued, so I'll grab right quick. So
Grab
you'll
on,
add
grab on.
So I agree 110%, but I will add a little bit of context to that last bullet of yours. When we're talking about the last 5 years and the next 5 years, let me tell you that at the end of the day, consumers and clients still want the same thing. They want convenience, they want speed, instant gratification for it to work and for it to work right. It's just leveled up over the last few years. And so for me, from a banking standpoint, I actually hope we don't see a whole lot more consolidation, but I do hope that I see a lot more partnership. So partnership with service providers and financial technology players in order to develop newer digital experiences that level the playing field and allow for all banks of all sizes to be able to compete and to provide the best products and services to their communities. Now, that is what I actually think will happen, because I think leveraging data is going to also level the playing field. Everyone knows data right now is the most valuable asset. There's a reason that Apple has a credit card. They want to be a bank. They want to be a community bank. They want access to financial information to be able to market. So the better we get at leveraging data to be able to not be reactive to need, but actually be predictive to need, I think is going to be major over the next few years as well. And then I think really from the last thing I'll throw out there, and this is just more of a futurist view, I'm not sure, have folks seen the most recent Rocket Mortgage commercial with their app, that they now will also allow for you to see your subscriptions and to cancel your subscriptions? I don't know if you guys have seen that. That's a mortgage app, y'all.
Yeah.
Okay, so what does that mean? That means banking as a service and open banking is leaning and gearing us toward the super app or the super-ish app. Now, I'm not going to say we're going to do the super app thing, but I do believe that we may be moving into app fatigue. We may be moving into app overload. And as you continue to see open banking architecture to disintermediate, I think we may see some of this stuff come together into more convenient experiences in the banking sector. I know Elon Musk said something about an everything app. I don't usually agree with Elon Musk on most things, so please don't take that as some type of me endorsing or signing off on an Elon Musk statement. But I do think that might be in our financial future.
I'm just reading his book right now. Pretty cool book. For me, I think it's the great wealth transfer and the way that people in my field communicate with their clients. Men investors, when they come walking into my office, they want to talk about return. How much money are we going to make? And then when female investors come in many cases, they have acted as a caregiver for aging parents. So when female investors come in, they never ask about return. They never ask about how much money are we going to make. What they're concerned about is, I don't want to be a burden on my children. What do we need to do so I'm not a burden on my children? So in my field, I think the biggest change over the next 5 years is how we communicate to our clients and the services that we provide. People are going to continue to demand more services for the same fee we charge. So I think that's going to be the two biggest differences.
Well, thank you all very much for this discussion. Please thank panel number 2 for all of their feedback.